Global bond markets are in crisis. Martin North, John Adams, in the interests of the people. Hello, John.
Hello, sir.
Well, are we in phase 3 of the crisis, do you think?
We started at the beginning of last year talking about the economic Armageddon had started. So I've been writing about this since about 2016, 2017 in the Australian press. And what we talked about at the beginning of last year was the repo market blowing up in around August of 2019. Then we started the pandemic last year, and then the markets blew up in February and March, and that's when they announced QE to infinity, and that calmed everything down. Now we enter 2021, and we've gone now into a third phase of this economic Armageddon thesis that I've been promoting, and it really blew up in the last 2 weeks. Now, what's the cause of this? So. In the last 2 weeks, we did a show about my thesis of accelerated stagflation. So the thesis I put forward to the audience last year was stagflation had started, which is low economic growth, high unemployment and rising prices. And we went through a number of shows last year about that. Then 2 weeks ago, we did a show and we went through the Biden policy agenda, particularly on the economy, and I basically said that he was going to fasten this process of stagflation because of additional stimulus, 1.9 trillion on COVID relief, 2 trillion on climate change, and there's a whole host of regulatory policies which were going to cost jobs and drive restrict economic supply and then drive prices up from the supply side. It would appear to me that the market, so this is now a global phenomena, but it really started in the US. The US bond market has really picked up on this thesis that I put forward. And the fear that has been raging through bond markets across the world, starting in the US, is that inflation is picking up. And if inflation is picking up, that means that the real rate of return on bonds goes down. And people don't want to actually have a financial asset where they're losing money. So what we have been seeing is a sharp sell-off in bonds across the world, particularly long-dated bonds, that has driven up the interest costs. And that's obviously been a concern for central banks and governments because we have the biggest debt bubble in the history of the world, and rising interest rates is a threat to that bubble. Because if the interest rates got to a particular level that people could no longer afford the interest service costs, that would then lead to defaults, and that would trigger the biggest depression in world history, which is effectively what Harry Dent has been talking about. And what we can say categorically is that ever since the GFC, the central banks and national governments around the world have done everything they can to stop this depression from happening, and they obviously just add more fuel to the fire, compound the problems, and that's why the debt bubble continues to grow and becomes more fragile and more complex.
Yeah, and just to underscore that very simple point, John, because people often are confused, there's a difference between bond prices and bond yields, rates, right? And so as the price moves in one direction, the actual real return rate moves in the other direction.
Yes.
So when you see the bond rate going up, it means the bond price is falling.
Yes, and the reason why the bond prices are falling is because people are selling the bonds.
Yeah.
Yes. Now, it is very interesting. So I have a 6-year-old, and I was talking to my 6-year-old during the week, and because I just wrote an article about this crisis on my website, and we can put that up on the screen for people to have a look at. What I was saying to my daughter, I'm writing a story, and she goes, "Dad, what's the story about?" I said, "I'm writing about promises." And she goes, "Why would you write about that? That doesn't really sound like anything to do with economics." And so basically what I said was that we have governments making a series of promises to a whole host of people who have lent the government money, and we now have a situation where people are losing confidence in that promise, because the promise that governments have made is, if you give us a X amount of money, we will give you that money back in full with an agreed amount of interest. Now, where the confidence in that promise is eroding is, well, how much money are you really going to give me back in real terms? So, if you gave the Australian government $100, the government may say, we're going to give you $100 back. But what can that $100 actually allow you to buy in terms of goods and services if you have rising inflation? So what we are seeing is an erosion of confidence in central banks, in national governments, and we'll go into this in a bit of detail, because there is this narrative of we have low inflation. And without putting you on the spot, I mean, you did a show the other day on Walk the World with Stephen Meter where you said you don't see structural inflation. That was your language.
Yep.
I think the market disagrees with that assessment. I definitely disagree with that assessment. And now we are in a situation where if governments do nothing and central banks do nothing, these interest rates are going to continue to rise up until we have a default moment where some big fish will default, and that's obviously why we have already started to see action from a range of central banks and governments over the last 7 days in particular.
Well, yes, and what John thinks to understand is they are trying to control around the 3-year mark, particularly that particular price point. So what they're doing is intervening in the market to be able to try and keep the rates down as a set level. And then the markets are saying, we're not sure we believe you. So basically the traders there are trying to take positions. Of course, they very much like the volatility because they can trade the volatility and make money. So there is definitely something going on here in terms of traders taking positions rather than having a long-term strategic view of where rates are going to go. That's the first point. The second is, there's a difference in my view between, for example, inflation related to certain commodities like copper, which has gone up, and wages growth. Wages growth is really, really low in almost all Western countries at the moment. And if you compare that with the 1970s, where actually wages were quite strong and actually was the trigger of inflation, not seeing that at the moment. That's one of the reasons why I still am not convinced that necessarily the inflationary story is actually going to play out.
Okay, well, I mean, the governments around the world, I mean, even the US the US Federal Reserve said that we're going to have an inflation bump.
Transitory inflation.
Exactly. So
right?
as we
that's
open
not
up,
real inflation. That's just a little bit of wobbliness. That's because
it is.
The stimulus is being unwound, etc., etc. They will be the odd thing, but they're not saying for low. Of course, have said, well, we don't expect to see any real improvement in terms of wages growth until 2024, and therefore interest rates in Australia are going to stay low until 2024. So another example of nothing to see here. Move on.
Indeed. So that I think is complete baloney. But we'll get into why. Now, how did this crisis start? So the first thing we're going to do in this episode is we're going to talk about not last week but the week before. So from the February 22nd to February 27th, and basically what happened in that week. So let's just sort of put our first graph on the screen, which is the US 10-year bond yield. And so what we can see over the last 4 or 5 months is the yield, the interest rate has gone up about 2.5 times. So the market has been signaling when we had ultra low rates last year that as the economy opens up from as the pandemic sort of we can get on top of that through vaccines, etc. We're going to open up, and the opening up with all this stimulus that's been injected is going to lead to some short-term inflation, and that's what the market has sort of like that has represented. There has been a concern about, well, how high is this 10-year bond yield going to go up? Now, what happened on the 25th of February was that there was a bond auction in the US for 7-year bonds, and it was the worst result in the history of the US bond market. So they have a ratio called the bid to cover ratio, and that came in at 2.045. So this is for the amount of bonds on offer. They only had twice as many bids as what was on offer. Now you think to yourself, well, if you're offering 100 billion and people offer you 200 billion, that sounds like a very good result, because you had the money to raise you had enough bids to raise the issue or fund the auction. But this was seen by the market as a very weak sign, because typically they get a lot more people coming to the auction compared to what happened on the 25th of February. Now, what drove the weak bond result in particular was foreigners basically en masse said we're not going to buy these bonds anymore. And I know that one of the key points that Steve Van Meter said to you in your discussion the other day was that that Americans rely on foreign capital to fund these deficits, and because foreigners have been showing up, there has not been a problem to date. Well, in the last fortnight, there has been a big problem because on this particular bond issue, and I'm not sure whether the mainstream media has actually pinpointed why foreigners on this particular occasion have not decided to actually show up in a large number. Not sure about that, but there definitely was an absence of foreign buyers coming into the market. And dare I say, I think that if we continue to see weakness among foreigners wishing to buy American debt, it is one, people are nervous about the Biden agenda, which is extreme spending and also extreme money printing from the from the US Federal Reserve. And just to give some context about this, so last year the deficit under the last year of Trump, and this was with the pandemic, was $3.3 trillion, and that was a big number. Now, the projected deficit for 2021 for a fiscal year was 2.3 trillion, which is obviously smaller. And then obviously all of a sudden Biden's come in and said, well, on top of 2.3 trillion, on top of a debt load of 27 trillion, which is of September of 2020. So now we're probably about 28 trillion. So on top of that, we're going to add to the 2.3, we're going to add 1.9 for COVID relief, and we're going to probably add an additional $500 billion because they've got this 2 trillion over 4 years for climate change. And so we could be seeing a deficit for this fiscal year around $4.5 to $4.7 trillion. And that's a very different proposition to what foreigners and the market was expecting in terms of new deficits, where the debt was going, and obviously how you're going to finance that. So I think that's probably concerned global investors to a large degree. And I think the other thing that's probably driven foreigners not to fund the policy agenda of the Biden administration is the behavior of the politicians in Washington. Something I think can be said that maybe 20, 30 years ago, that Americans were very conscious about how they behaved and how they were perceived on the world stage. Dare I say that when you look at, and it's not just one side or the other, I think it's whether it's McConnell or Schumer or Pelosi or some of these people, they are behaving in such an immature and reckless way. Look, dare I say, I think people around the world are looking at Congress and saying, well, these people are not mature statesmen. Why would I actually give these people money? I don't trust them anymore. So I think there's a degree of lack of trust and confidence in political institutions, and that potentially could be playing into why foreigners have walked away from funding in terms of the particular auction. Although I should say, even among domestic Americans, they didn't show up in the usual numbers to actually participate in this bond auction as well.
And just on that, John, it's worth just reflecting on the flow over effect into stock markets, right? Because what we saw also there was that NASDAQ came off its highs, right? Because a lot of tech firms are basically valued on the future flow of revenue. And if rates are going to go up, that value is effectively diminished. And that means that their stock price is overvalued and therefore it comes back. On the other hand, the banks who actually benefit from rising interest rates actually move the other way. So you saw a big rotation and a net reduction in stock market performance over this period as well. So it's a good illustration of the way that the bond market has an impact not just on itself, but on other financial markets too.
Yes. Now, one of the key points that I should say is that when this bond auction failed on the 25th of February, that pushed the 10-year yield to 1.6.
Yep.
So that was the high, because we're recording on Saturday. So in the last 24 hours, the intraday high was actually higher than the 25th. But up until that point, 1.61 was the highest since the start of the pandemic. And that then triggered people to panic right around across the world, because the 10-year bond yield is a global, it's not just the American benchmark.
Yeah.
It is a global benchmark as well. So we then started to see selling across the world, and obviously it had a big impact here in Australia as well. So two points to sort of talk about in the Australian context. The first one is that some of our viewers may have heard about this term yield curve control that's been floating around, and that's slightly different to QE. QE is to buy bonds, print money out of nothing, and buy bonds up to a certain number. Whereas yield curve control is to ensure that you're buying bonds to keep the interest rate at a certain level. Now, last year, as the COVID-19 pandemic started, the RBA came out and one of their policies was to keep the 3-year bond yield rate at 0.25, and then in November they changed that from 0.25 to 0.1. So basically they need to keep that interest rate at that particular level, and the reason why they focused on the 3-year was that because that has a significant influence in terms of Australian banks and what sort of funding that they are able to get to basically fund their lending book, which is effectively mortgages. So now let's put graph 2 on the screen. So what we can see in this graph, Martin, is that the interest rate is supposed to be 0.1, but we see a lot of spikes. Now, particularly in the last 2 weeks, we are seeing a lot of spikes well above 0.1, and I think like like on this particular graph, the highest like this graph is showing is 0.15. Look, there could have been a intraday high that was larger than 0.15, but basically what the market is effectively saying is, well, we are not going to hold bonds if you're only going to pay us 0.1%, and that's why they're spiking. And in order, and obviously, if this target is not kept, the integrity and the credibility of the RBA is basically shot in the market, and so that's why they've been trying to intervene in the market to keep it at 0.1. Now, the other thing I should say is that if you look at the Australian 10-year bond yield, so again, since early November, the 5th of November, this interest rate has effectively gone up 2.5 times. And so at the close of Australian trading on Friday, we were above about 1.83, 1.84, so we were around that range. So again, we saw that happen in terms of the Australian market, and then now in terms of Japan, when we look at the 10-year government bond rate, they have a yield curve control target from 2016, which was around 0. So not a specific target, but like approximately around 0. Well, it shot up to 0.18. And so that obviously the Bank of Japan had to intervene to get that interest rate down. And then obviously in Europe, interest rates are negative. The bond yields are negative, but we saw again a sharp increase in the German bond rate. So a few months ago, it was negative 0.6, and then with this commotion on the 25th of February, it got up to about negative 0.2. So obviously the interest costs were rising in Germany as well. So that's the start of it. And obviously, when we have sort of seen in the last couple of years some issues among the developing countries. For example, perhaps Turkey or Argentina or Venezuela, etc., where they've had some issues in their bond markets, or in particularly in terms of what's been happening in Lebanon. Lebanon has a huge amount of government debt, and that has and their bond market blew up last year. So there has been some micro issues in some developing countries, but now we are seeing in the mature developed countries a new bond crisis is sort of coming to the fore, and so that's what happened 2 weeks ago. And I'll get you to comment before we talk about what happened last week.
Yeah, and just to say, at the end of that week before, of course, the Reserve Bank actively intervened by buying more bonds at the 3-year mark than normal, right? That's how they control it.
That was a very good point, Martin. So what the RBA did was, in order to control this 3-year bond rate in that particular week, was they came in with $1 billion worth of buying on the 22nd of February. They then came back into the market on the 24th of February, which was the Wednesday, with another 3 billion. And they still couldn't keep that rate at 0.1, and they had to come in on the Friday, and the Friday was the 26th. So this is after the American market had blown up, and they intervened in the market again with another 3 billion in order to keep the interest rate down. But clearly there was a lot of pressure on the RBA because the interest rates on the 3-year bond yield was continuing to spike up.
Yeah, and it's important that people understand that when that happens, it means that effectively of the bonds being issued, a greater proportion ends up on the bank's balance sheet. Right?
Yes.
And if you actually ask the question, well, what proportion of the last issue end up on the bank's balance sheet? It's a big proportion of the total.
Yes, and that again tells you a lot about what the private sector is trying to tell the government in terms of their confidence, in terms of how much more of debt they're willing to fund, but also their expectations around the interest rate, but also in terms of inflation.
Yep.
Now, so we had this whole issue blow up on the 25th of Feb. Bonds sold off across the world. Bond yields started to spike. Then on that weekend, which was the 27th and 20th of February, there was a meeting of finance ministers, particularly all the senior ones, and Yellen, obviously as a former Fed chair, now the Treasury Secretary under Biden, basically urged countries not to withdraw stimulus, but to commit to their existing stimulus programs, and also said that if there was ever a time to go big, it is now. And that was a very telling signal coming from Yellen, because it's a new government. They want to be successful. They don't want to self-inflict a crisis, they don't want to self-inflict a crisis on them. And so obviously they're just trying to do anything and everything they can to keep all parties with this global coordinated policy. They're trying to commit everyone to just keep on fueling this debt bubble so that doesn't blow up. Now, when we start last week, so we're talking about the 1st of March, Australian time, big article in the AFR to start the morning trade. The RBA announced that they were doubling their bond buying program from 2 billion to 4 billion. And that was an attempt to try to cool the markets. I think it had a very short-term effect.
And just to say, that's per day.
Yes, exactly.
Very important. Yeah. Each day.
Yes. And clearly, you could see throughout the last week, particularly on this 3-year bond target, the interest rate, like, they were continuing to spike. So even though they doubled, so you think to yourself, if you're spending $2 billion a day and you can't get the interest rates under control, well, we're going to come out and double it. And they still couldn't control it because the interest rates kept on going up throughout the week. Now, it's interesting that on Tuesday, the RBA board had their monthly meeting in March, and there was a statement at 2:30 on Tuesday released by the RBA governor. He had some very interesting things to say. And look, I just want to bring this up on the screen because I think what he said, the market's not buying. Wage and price pressures are subdued and are expected to remain so for some years. In underlying terms, inflation is expected to be 1.25% over 2021 and 1.5% over 2022. CPI inflation is expected to rise temporarily because of the reversal of some COVID-19 related price reductions. The board will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. For this to occur, wages growth will have to be materially higher than it is currently. This will require significant gains in employment and a return to a tight labour market. The board does not expect these conditions to be met until 2024 at the earliest. Now, Martin, a couple of important points for me is, as soon as this announcement came out at 2:30 on Tuesday, what happened in the Australian bond market? The interest rates went up.
Absolutely.
Now, why did they go up? Because there was heavy selling on this statement. Why did that happen? Was because this story that the RBA is selling to the market, that they did not buy it. Now, going back to my original premise that I was talking to my daughter about promises, well, the market is effectively calling the RBA governor basically, either maybe a lie is too strong, but not telling the full version of the truth. Now, we've been calling out the RBA governor, for quite a few years, saying that he continues to lie and misdirect about the state of about the Australian debt bubble, the Australian property market, etc. So it seems that the bond market has, and the bond traders in Australia have finally caught up to what we've been saying for several years about the RBA governor. Now, that's point one. Point two is the implicit assumption in this statement is the Phillips curve. So there was an economist in the last century who took about 50 or 60 years of data and found that there was an inverse relationship between inflation and unemployment. His surname was Phillips, that's why we call it the Phillips curve. And basically, this statement is assuming that Phillips curve is true, so that inflation will go up once we have a tight labour market. We need, and that's where we get the wages growth. Therefore, we need to maximise employment. Now, again, a lot of this was the basis of Keynes's theory, Keynesian economics. In the 1970s, that blew up because unemployment and prices rose simultaneously. That's not supposed to happen under the Phillips curve. And if my thesis is correct that we have stagflation, what this statement is showing is that the RBA is going to be caught out because they're assuming that we're not going to have any inflation while unemployment is relatively high because of the pandemic and everything that happened in 2020. Now, I think they're going to be caught out, but if people want to understand what is driving the thinking of the RBA, it is this Phillips curve Keynesian paradigm, and we do know from history that this paradigm has been proven to be false, and I think they're going to be proven false in the next 1 to 2 years as well.
Right, and just to be clear, John, he is drawing, and it's the point I made earlier on, a direct link between inflation and wages growth.
Yes.
Right. So basically, the argument is until we see wages growth, inflation, we don't have to worry about it. We won't see wages growth until unemployment goes down, because once unemployment goes down, people will actually have to be paid more, and therefore that's how it all works out, right? But the point is there are a whole bunch of reasons why wages probably won't rise. And as you said earlier on, there are other indicators of potential stresses and strains in the economy which suggests that maybe inflation is not as low as he thinks it is.
Yes. The other key point I will make is that on this issue of wages is, well, what drove stagflation? What was the trigger for stagflation in the 70s? It was the price of oil, and it was a number of OPEC shocks that basically reduced supply and drove the price up. Now, if anyone can look up, what the price of oil now, the price of oil is going up quite aggressively.
Yeah, and it's worth, I think, also saying that, of course, the way we measure inflation, CPI and what have you, is myopic. We've covered that before as well.
Yes. Now, in terms of so this is covering what happened in Australia. Now, what happened in the US was, so in the first couple of days of the past week, Monday, Tuesday, the 10-year bond yield held quite steady at around 1.42. Then on the Wednesday, it went up to about 1.47. And in the last 48 hours, we've had some comments from Jerome Powell, the chairman of the Federal Reserve, and he has basically admitted that we are going to see some temporary inflation as the economy opens up, but that is going to be relatively subdued, and there's no inflation story to be had.
John, one of the interesting things about Powell's comments was that he said, there might be some inflation, but it's very transitory. There's no real signs, and that actually might be quite good because it's a sign of the economy beginning to recover from the virus, right? And he basically gave absolutely clear signals that they will have no intention of going out along the yield curve, right? So there's no intent to buy at the long end to try and support, to keep the long end in a particular place. He was going to focus on the short-term rate that they were actually looking at the moment. The markets didn't like that.
You are absolutely correct, Martin. So the reason why the bond market didn't like it is, I think, from a couple of points. One is they didn't like the whole mention of short-term inflation because they are hoping for no inflation. So the fact that he admitted inflation is coming So we know that inflation is coming because they're pricing that in. But the fact that he went out and actually said we're going to have some inflation in the short term, that definitely triggered a whole bunch of short-term traders and algorithms to start selling bonds. And there are some stories at Ordinary Zero Hedge about huge amounts of bonds, short-term bonds being shorted as well. So people are looking at this from a short-term trading point of view. That's why the bond yield went up quite aggressively in the last 48 hours. The other key point is that particularly the Wall Street banks, they were hoping for some sort of additional support or announcement, kind of like what happened last year. The share market fell about 35%. The bonds were starting to get into wobbly territory, and that's when they came out with QE to infinity. Well, you think to yourself, with QE to infinity, what else can they do? Well, there is this talk about yield curve control in the US, so they are expecting a further announcement from the Federal Reserve. That didn't come in the last 48 hours, and that definitely has spooked the markets, and that's why bonds are continuing to be sold off.
And I'll just add two things. The first is, if you look at the bond markets, you mentioned the algorithmic trading. There are a lot of machine trades done in the bond market. In other words, it's not traders taking a position and saying, I'm going to buy or sell, right? It's an automatic response to volatile movements of the price. And the bond markets are very exposed to that. The second is that there are quite a lot of people who short bonds, and when they do, they effectively create a copy of the bond, which means you start getting this multiplier effect. So the relationship between the underlying and all the trades multiplies, and that amplifies movements in the markets and creates more volatility and creates more opportunity for traders to make money through the volatility. People need to understand that this bond market is just like the other financial markets. It's somewhat rigged.
Absolutely. Now, in terms of as we go forward, so there's a couple of points that I'd like to make. The first one is that if they kind of like we said at the beginning of the show, if they allow these bond yields to go up, we're going to have a problem around debt servicing. We're going to have a default. We're going to have a new financial crisis, kind of like 2008, and then we're off to the races in terms of the Harry Dent thesis. So that's why they need to cap these interest rates, kind of like what the Australians are doing with the 3-year bond yield. Now, yield curve control was actually implemented during World War II in the United States in order to fund the war. In order to fund the deficit, to fund the war effort, they did yield curve control, and it proved to be like in the late say 1944, 45. It was actually very inflationary. So on the one hand, they need to basically flood the market to stop the bond market from blowing up. But on the other hand, it's actually going to cause inflation. And so to me, it seems like they're in a catch-22. So what I think is going to happen is that two things. We have a number of new bond auctions coming up in the next 7 days. If the Americans don't get a lot of support for these new issued bonds, we're going to see the bond market continue to blow up, and dare I say that interest rates will go through the roof. So in order for that to happen, that's why I think if they don't announce something in the next 7 days, the Federal Reserve have their monthly meeting on the 16th and 17th of March. I do expect that at that meeting they'll be making some sort of announcement, whether it's around yield curve control or increasing QE or something. There'll be some sort of announcement. And so now, the reason why I chose the title of the show is that we have a crisis is that what happened on the 25th of February has now forced the central banks to come to the table with something new. So we were tracking along, opening up the economy, even though we had huge debts and huge deficits, and we could see inflation was coming through. Well, now the market is saying, well, you need to give us something more so that this bond market's not going to explode even further. And that is basically the central banks are now in a position where maybe they thought we could avoid additional action. They can't avoid it now. So I expect additional action to occur. I do think that's going to prove to even be even more inflationary going forward. And it'll be very interesting to see whether they can continue to whether they can try to put the genie back in the bottle. Now, I don't think they can. Now, what are the consequences? So, because people think, well, okay, so the bond market's blowing up. What does this mean to me? It means a couple of things. First off is for governments that have huge debts, it means that they have to pay a lot more interest. And I think in the last week or so, there was an article suggesting that the deficit for the Australian government could be an extra $15 billion just in terms of interest cost. And you think to yourself, what can we do in terms of meeting the public's needs with $15 billion? We can do a lot of things, but if we have to just pay that on the interest, I mean, we did a show, I think, about October, November last year when the Front Bill released the budget, and I said goodbye Australia. And one of the things is that like these huge government debts, it is going to be the death of us because our ability to balance the budget and pay these back is in question. But particularly if interest rates go up, I mean, that's going to really put a crunch on governments and what services they can provide to the public. So that's point one. Point two is when it comes to the banks. So obviously, if interest rates on these bonds are going up, that means that to a certain degree, the capital costs, the cost of capital for banks will go up, and banks will pass those costs on to customers, particularly if they have variable interest mortgages.
Yeah, I think the issue with regard to mortgage rates is quite interesting, right? Because there have been very, very remarkably low fixed rate mortgages in particular, right? And that's because of the term funding facility that the Reserve Bank has been flowing very cheap money into the banks. That's not going to last forever, right?
Yes.
The banks will then have to access slightly more expensive money, right? Or a lot more expensive money, depending on where the bond markets are going. And so that does create the potential for significant rises of future fixed rates. But the really interesting question is what happens to variable rates, right? Because the variable rate is not set directly by the Reserve Bank. The variable rate is a consequence of market operations of all the banks and their funding. So therefore, we could absolutely see an out-of-cycle rate rise on variable mortgage rates. And even a small mortgage rate rise would be pretty devastating to a large number of people, I think. So people need to be very conscious as they make any preparations to get a mortgage at the moment.
Yes. About 3 weeks ago, you and I did a show about Australians overdosing on debt.
Yep.
And what I can say is that, and if people follow me on social media, I put up some posts in the last 24 hours. So in our last on that particular occasion, we talked about what was happening in terms of credit growth according to the RBA statistics. At that point in time, I was hearing very robust anecdotal stories about December, January, in terms of Australians going out there, particularly bidding on houses, high six-figure, seven-figure mortgages being sold or being signed up in terms of applications and actually getting funding. I checked in with a couple of mortgage brokers about February. They said February was stronger than December and January. You think about property prices, the peak was 2017. What I've been told in the last 24 hours is that the demand is not just for houses. Investors are back in the market in terms of people trying to bid on things in terms of Western Sydney. Even though we have said, and I know you've done some shows with Edwin about apartments, what I've been told is that there is more demand for apartments. It is still weak relative to houses, but the apartment market's coming back. And people have just said that the market is just on fire. So we've done a show about this, and you said to me on the phone today that people are not signing these mortgages on the basis, can I pay this debt off? They are looking at this from a cash flow, short-term perspective. Can I afford the mortgage repayment today? That's how people are making these decisions. And obviously, if you see the bond market continue to blow up, if these interest rates on the bond yields continue to go up, independent of the RBA, those people who have signed up a large mortgage on variable interest, they are going to be in some sort of trouble.
Well, we certainly know that a lot of people have very little headroom for rises in interest rates. And a lot of people have refinanced onto lower rates at the moment, but those who on variable rates are certainly more exposed. Our market here is very different to the US, right? In the US, most people have a fixed rate mortgage. So when rates go up, it doesn't have a dramatic impact. Here, because most people are on variable rates, we are much more exposed to volatility in the mortgage rate market. And if the bond markets go the wrong way and rates rise, then this is a very significant factor for many households.
Yes. In the last few days, I have been on the phone with quite a few parliamentarians. Some parliamentarians are aware of what's going on. Some of them were not. We have an election either at the end of this year or sometime in 2022. The point I made to people was that the government's message is not washing with the bond market, and so this is not just an issue of credibility for the RBA. This is an issue of the credibility of the Prime Minister and the Treasurer. So those politicians in the government need to be aware that the government needs to recalibrate its policies and message so that the bond market is convinced about this low inflation story. But the other point I made was that if you're going to go walk into an election with either high interest rates, when the data is clearly seeing that a lot of Australians are going out there borrowing obscene amounts of money, or if you implement bigger QE programs to control the bond market, you're going to have an inflation problem, and a more exacerbated inflation problem going into an election, and that could be very bad for the political fortunes of the government. So at some point, I do expect that this is no longer a bond market central bank issue, and this is going to enter into the political arena. There's a question about, well, how much interest can they actually service? How credible is that to the market? And we could start to see some very big turmoil in financial markets right across the world.
Yeah, and John, just to underscore one thing, right? I still don't know whether we are clear about whether the outcome is deflationary or inflationary, right? I can still play it two ways from this point, but it rather depends on what central banks do, how much more quantitative easing they do, all those things, right? It's still not clear to me what those two futures look like.
Well, so what we can say objectively is that we have had crisis points in the last 13 years since the GFC around the world, and every time there was a crisis point, whether in Europe in say 2012 with the Greek crisis, or the repo crisis, or COVID-19, and every crisis point, the central banks have done everything they can to stop the deflation story from playing out. And so I do expect them to try again. That's why I think we are headed towards, so like I said we had stagflation last year. I said we're going to have accelerated stagflation. I think that now that central banks are now forced to come up with new policies in response to this bond crisis that has emerged in the last 2 weeks, I do think that the inflation story is going to get worse over the next 12 to 24 months. And that, again, from an individual point of view, you have to be very cognizant of have you arranged your financial affairs for an inflation environment or a deflation environment? And I think our audience knows I've prepared for inflation. I think maybe you've prepared somewhat for deflation, and we'll see what happens to our wealth as we go forward.
Well, yeah, I would say I've tried to protect upside and downside because I'm not sure which way it's going to go. And I just make the point: Bank of Japan has been at this the longest. No sign of inflation in Japan. Eurozone has been at this second longest. No sign of inflation. In fact, deflationary pressures there too. So this quantitative easing journey that the central banks have been on, right, and some have been on it much longer than the Reserve Bank in Australia, hasn't necessarily led to an inflationary outcome. Interesting to see whether that changes. It may not.
Well, all I'll say in conclusion is when we talk about, well, can we see evidence of inflation? So now we can talk about house prices. We can talk about the...
Yeah, but that's not in the CPI.
Oh, yeah, sure. So house is not in the CPI, but we do know that the average Australian, the average person around the world, they have an issue with the cost of living. But the other thing from a mechanical point of view is that, so yes, the Bank of Japan has been printing a lot of money. Now, Japanese bonds are funded domestically. Australian debt and American debt is actually funded by foreigners. And even the MMT crowd says that MMT can only work when you don't rely on foreigners to actually fund the debt. So when we have an issue with foreigners saying, well, we don't trust that you're going to be able to finance these or pay back the money that we lent you, or you're going to have an inflation problem, that has a different. The Japanese context has a different connotation for Australia, but in terms of as well as the US. But the other central point that I think some people haven't come to grips with is, so when for example in Germany in 1923, when the central bank printed huge amounts of money, this was paper money that was flooded into the real economy with real people with wages, etc. Now, when we've been printing all of this money since the GFC, where's the money in the bulk gone? It's gone into the bond market. So we have seen that the bond market has exploded in size, and that's where the inflation is trapped. If yields go up and they sell the bonds, that money then is released from the bond market, and then that starts to seep into the real economy, and that's where the inflation story will come in. So that we have had inflation, it's trapped in a box. It's called the bond market. If that bond market has a problem, well, then you're going to see a flood of that come into the real economy, and you're going to start to see prices go up quite aggressively around the world. And again, for the average, typically inflation hurts people who are on fixed income. So the pensioners, in terms of young people, and particularly in terms of the unemployed. But also the other thing is that John Maynard Keynes talked about sticky wages. So if we don't have flexible employment conditions and we have employment wage salary contracts that are quite fixed, well then again people's cost of living will go up, and those wages won't respond in time for them for those wages to be offset. We are, I think, in a very tricky situation. But yeah, if people want to say, well, where's all this money going? It's in the bond market. If the bond market blows up, well, then you're going to see it on the streets.
I've got this little vision of, like the old fire alarm, in case of fire, break glass, right? It's like this little box and it says, in case of inflation, break glass. That's the bond market, right?
Yes.
John, we'll see. We'll see how it goes. And obviously we'll report back on the channel as things develop. I think it'll move quite fast, so we'll keep people informed.
Absolutely.
Thanks for your time today.
Thank you.
Martin North, John Adams. In the interest of the people, we'll see you next time.